So are we getting close to the end of this bull cycle? And when I say this, I mean a bull cycle that started pretty much at the end of 2022 and has been going nonstop up until right now. I mean, we've gone from 3,800 on the S&P 500 to 5,500 in 18 months. That's a 19% return in 18 months. Absolutely insane. Now, Warren Buffett coined a very important phrase that basically goes like this. I'm about to butcher it, so forgive me. It basically says, look, when everybody's bearish, I'm bullish, and when everybody's bullish, I'm bearish. And right now, it seems there's a lot of euphoria and a lot of bullishness in this market, a lot of retail participation. People want in on this party. And that is usually the ingredient when people start to smell the soup of the end of the rally. So a lot of people are anxious and worried that we might be getting close to the top of this market and they would like to make some adjustments and prepare themselves in case that happens. Now, in this video, what I'm going to do is I'm going to provide you the same answers I provide to myself because much like you, I'm also an investor and I also really want to know whether we are close to the end of this rally. So I've analyzed all the data, all the objective facts, none of my gut feeling or emotions, because when I got a gut feeling, I go to the toilet. This is not about feelings or emotions or speculations. This is about data. Now, let me tell you something very important. Now, if you invested money, let's say $10,000 in 2003 in the S&P 500, and you kept it there all the way for 20 years to 2023, by the end of that period, you're going to have $64,000. That's easy, right? Now, if I take out of this the top 10 days from a 20-year period, 20 years of investment, and I remove your best 10 days out of it, the return is going to drop from 64,000 to 29,000, slashed by half, more than half, by removing 10 days. 10 days, all it took. That's it. So if you actually miss out on the top 10 days, your return for 20 years of investment is going to come down by 50%. Now, I want to actually explain it a little bit further. You see, 7 out of those top 10 days between 2023 and 2003 happened during what was defined as a bear market. Yes, the market tends to be irrational short term. In fact, in 2020, which now seems like ancient history, but was just 4 years ago, in 2020, the second best day of the entire year came on the heels of the worst day, just 24 hours prior. If you missed out on that because you got fooked out, because you got spooked, oh my God, I have to have fooked out on a t-shirt. I mean, look, timing the market is very dangerous. Not because you're just going to lose a lot of money. It also means you're going to miss out on a lot of profit. If you miss out on specific days, you're going to lose half of your profit. Timing this whole thing is not a good idea. And yet I see a lot of people talking about potentially trying to get out before the market collapses. A lot of people are thinking that this is a very similar situation to 1999. Back in 1999, for those of you who are young enough not to remember this atrocity, in 1999, every single company that said, hey, we're going to have a website, .com, right? Like everybody's now saying, oh, we're going to have AI. Every time somebody mentioned .com, like they mentioned AI right now, the company exploded right out of the stratosphere. And then the market went and took everybody with them to the bottom. Now, I want to explain why today in 2024, it is in fact nothing like 1999 and put your mind at ease. I don't want to freak you out. I don't care about the clickbait. I just want to give you guys good information and I want to relax you. I'm not here to fearmonger for clicks. You see, right now, 2024 has nothing to do with 1999. It doesn't mean the market can't correct. In fact, the market, by all statistics, will drop 5% 3 times per year, 10% once per year, and every 3 years, the entire index is going to drop 15% in a single specific year. It always does that. Always. Corrections are part of the game. But are we ahead of a massive market collapse like 1999? Well, if you look at the data, I want to show you something. Back in 1999, when everybody was talking about getting in the market, the participation was crazy. Look at the amount of initial public offerings. How many companies went public in the 1999 dot-com bubble when everything was bubblish. Well, we had 400 IPOs in 1999. Now, in 2021, when we had this explosion of the COVID investing bubble, we had 1,035 IPOs. So these are the numbers we're talking about. 400 in 1999, 1,000 in 2021 when everybody went crazy. Last year in 2023, we had a total of 150 IPOs. This year, we're on track to do 170 IPOs. There's no IPO activity that signifies any sort of euphoric environment. If this was a hot market, when it would be easy to get high valuations and go crazy, the amount of IPOs you would have seen would be in the range of 400 to 600 IPOs, and yet we're at 170. It's a completely calm situation. Companies are not running to the stock market because the market isn't that hot. Now, let me show you something else. I have a lot of data here, so stick with me. This is about to get interesting. Now, another point I want to mention is the PE, the price to earnings ratio. Now, we look a lot at PE with specific companies, right? We analyze a company and we say, well, their price to earnings is X, and then the forward PE might be Y. And that's how we analyze how expensive or cheap a specific company is. But did you know there's actually a PE for the entire index? You take all the PE of every single company in the S&P 500 and you make an average to figure out how expensive or cheap the entire index is. Simple as that. Now, in 1999, the PE, the price to earnings ratio of the S&P 500 was 33. Insanely expensive. I agree. Right now, we are at 24.8. Nowhere close to 33. In fact, if you look at the median PE, we're currently at 16 to 17. On top of it, we have statistics that show us what is the average performance of a bull market before it ends in the US stock market. And here's the thing. The average bull market in the US is about 114%. The median, by the way, is 77%. Right now, since the end of 2022, the beginning of this bull market and the release of ChatGPT, we did 18.5%. And yes, 2023 was a great year. In fact, if you go back 1 year from today, we've done almost 30%. Now, that seems to be bothering a lot of people who are telling you, hey, we've done too much. We don't like to make money. It's time to sell. Well, hold on a second. Let's look at the stats. Every time the stock market has gone a 30% 12-month period, which happened 27 times, what happens next? Well, 25 out of those 27 times, the market in the following 12 months is positive. So basically, I can tell you that statistically, if a market had 25 to 30% in a specific time frame, which is a year, statistics show us that 25 out of the 27 times that this happens, the next 12 months are profitable. How profitable? Well, that changes, but at least it's not a bad sign. The profitability in itself isn't something to get spooked about or get annoyed about or get anxious about. Profitability isn't bad. Now, especially if you look at the macroeconomic data. Now, I get it. Things are expensive. Life is difficult. I totally understand this. Trust me, as a son of immigrants, I know how tough things can get. But right now, if you're looking at the macro data, at the big data, not at the specific life of a specific person, the macro data shows us that inflation is under 4% and the job market isn't collapsing. At the end of the day, if you go back and you look at the market crashes that happened, a lot of them happened because the underlying conditions, the economic conditions were not good. In a good economy, sometimes crashes happen. I totally get it. But for the most part, when you have good economic setup on the macro level, it's very hard for the market to collapse. And that's why I think a lot of the chatter about the whole 1999 comparison is a big misunderstanding. A lot of people who are explaining this to you have no idea what they're talking about. Because in 1999, you had companies that had no business being public, without any profits, without any earnings, without anything but an idea, a name, and a story, going public, getting crazy valuations. Right now, what's leading the AI bubble, so-called, the AI revolution, is the mega caps. The mega caps are leading the way. It's not the trash companies that nobody has ever heard about. It's literally the opposite of what happened in 1999, where all the small companies have ballooned out of the stratosphere. Right now, we have the best companies in the world basically jumping ahead with AI ahead of everybody else. Now, if you look at Microsoft, massive leader in AI, $3 trillion market cap. Revenues $240 billion. They're actually generating money on this. NVIDIA, $3 trillion, 80 billion annual revenues. You look at a company like SMCI, who builds the servers, right? It's a $50 billion company. Tiny compared to NVIDIA and Microsoft, but it's a $50 billion company with $12 billion of annual revenues. Even if you look at a company like Palantir, who's just in the diapers of getting in the AI business on the software side, Palantir is a $50 billion company with more than $2 billion of annual revenues. These are companies who are actually generating money with great fundamentals. This isn't just hot air. In fact, if you just remove the Mag 7 out of the S&P 500, just for the exercise, from the end of 2022 to now, the amount of profits we're going to have are going to be slashed by half. It's literally the Mag 7 who are creating this bull market. It's not a bunch of cockamamie companies with a cool story. Now, a lot of people tend to also forget the fact that we are in an election year. Yes, I know things are going hectic in the market, a lot of geopolitical stuff, but we are in an election year. And one thing about elections year that you need to know is they tend to be very bullish for the market. The average return on the S&P 500 in an election year is 9.5%. In fact, if you go back all the way to 1928, what you're going to find out is that 74% of all election years were actually positive on the S&P 500. On top of it, people kind of forget that we are in a 5.25% rate environment. The interest rate right now is extremely high. And it went up super fast, probably the fastest pace we've seen since Paul Volcker. Now, even though we're currently domiciled in a 5% interest rate, the earnings have been nothing but spectacular, and they're getting better by the quarter. Basically, what happened is that corporate America completely adjusted to that 5% environment. And what would happen when the rates come down, which they should by the end of this year, the beginning of next year, when rates starts dropping down, profitability will improve because the cost of money will be much, much cheaper and people will have way more available income to spend. A lot of this is just the beginning. The great earnings we're seeing right now are going to be way better once interest rates start to drop. Look at what's going on with these small caps. Tom Lee always keeps telling you this. Look at the IWM, the Russell 2000. Look at this. Year-to-date performance, 0.2%. While the entire market is flying up, small caps are at 0.2% for year-to-date. For the past 6 months, they have done nothing. What will happen to these companies who are very sensitive to interest rates once rates will come down in the end of this year or the beginning of next year? Obviously, this will fly up, and obviously, it's going to take the market with them. Now, look at the QQQ. The NASDAQ, right? The NASDAQ, since the beginning of 2023, went up from 280 about to 480. So that's a 70% increase. That's massive, right? The NASDAQ has been going crazy. Oh my God, it's time to run out of the NASDAQ. Guys, we have seen the introduction of ChatGPT in November of 2022. We have done 70% since. Fine. Look at the future by learning the past. Look at the history. Back in 1994, when the world was never going to be the same again by the release of the internet, Netscape came out, 1994. And I would argue Netscape and the whole invention of internet is just as big as the invention of AI. AI might be actually even bigger, more important. When that happened, the NASDAQ basically ran up for the next 2 years for 110%. So basically, the index is not even close to where we were in 1994 when a big thing like Netscape came out and the internet got invented. ChatGPT is just as big. We're currently just probably halfway there. I think we can do way higher than 110%. And right now, we're getting to the most important part of this video. Check it out. If you were to boil down this video into 2 important points, those points will be very, very simple. Number 1, when you hear experts explain to you that NVIDIA is very similar to Cisco back in 1999, Cisco that went up like crazy with the invention of the internet and then came crashing down. And a lot of people are saying, well, NVIDIA is that. Run away. Run away because those people have no idea what they're talking about. Telecom and servers have nothing to do with each other. The CapEx investments that NVIDIA is going to generate for a lot of these customers are going to go 3-5 years forward at imaginary amounts. And the cycle of development of the new chips and the new hardware and the new infrastructure is going to carry NVIDIA well into the next decade. It's not going away. It's nothing like Cisco. And the second part, I want you to understand that this is not 1999 in general. The current bull market is nowhere near the euphoria we've seen in 1999. The fundamentals are way, way better. And the specific leaders of this rally are companies who are actually generating profits on this new technology. And we haven't even started it yet. This is just the beginning. But the most important part is I want you to understand that trying to time this and trying to get out at a specific time because you think the market is getting too hot might not be a rewarding exercise. Because what happens, as I showed you in the beginning of this video, all you have to do to slash your profits for the next 20 years by half is miss the best 10 days. If you miss the best 10 days, half, Eddie, half. Don't do it. Now, Vanguard, KKR, and Bank of America all these studies that prove what I'm saying. It's not me saying it. Look, the top 1% of investors in America have one thing in common, which is they mostly invest in stocks. 61% of their net worth, of the top 1% of Americans, is in stocks. When you look at the bottom 50%, it's about 4%. Investing is a cheat code. The rich people understand it. The poor people think they're not allowed in the game. If you go back to that 1%, the top 1% of Americans, mostly in stocks, 82% of them are in US stocks, 95% of them are actually mostly in ETFs and funds. Only 5% of their portfolios are in individual stocks. And they're completely inactive. It takes them 12 years to turn over the entire portfolio. 12 years. The banks, the sell-side analysts, the brokerages, the media, they want you to be active. They want you to sell every day, to buy every day, to look at the news, to look at the charts every single day. They want you to have this frenzy, emotion reaction when you bounce like a pinball from side to side while they make money by just staying in the market. The top 1% of investors in America takes them 12 years to go through their entire portfolio. Remember that. Don't be fooled by this bullshit. Media and brokerages are in cahoots to get you to be active and to get this frenzy in your head so you make stupid emotional decisions. This ain't 1999. We're in the beginning of a massive bull cycle. It might correct multiple times, which would seem horrible, but in the long term, the ones who will stay in the market for the next 15 years will be rewarded. The ones who try to jump in and jump out might miss out on a generational opportunity. Don't say I didn't warn you. Now, as always, I would like to invite you to join our community on Discord, discord.gg/TomNash. It is absolutely free to join. Those of you who would like to take the next step and join the Academy on Patreon and get more perks on the Discord and weekly lessons and all that, patreon.com/TomNash. We would love to see you there. We got a 30-day money-back guarantee if you don't like it for any reason. And those of you who would like to get better at analyzing stocks, I have built a tool for that. It's called Stock MVP. It has everything you need. It has a DCF calculator, compare mode when you compare multiple stocks. It has analysts, insider selling, everything, all the fundamentals. It has valuation calculators, a 5-year price targets, everything. Stock-mvp.com. Try it out for 1 week for free before you commit. Thank you so much. I'll see you in the next one.